Hello and welcome to Business Matters at the Hindu with me, K. Bharat Kumar. Why should you, yes, you, keep an eye on your country's export-import numbers, or in other words, trade deficit? Don't worry, no stress. This is not some deep lesson in economics because I'm not an economist myself. But it's useful to have your eye on these numbers that come out monthly because over time it could impact your ability to make your purchases, your dream purchases, or even your monthly bills, for better or for worse. First off, what is a trade deficit? When a country exports lesser than it imports, a trade deficit occurs. It does mean that it buys more from foreign nations to supply to the local economy than it manufactures here and sells outside. Unhealthy as it may sound, a deficit is not always unhealthy. When a country is on a path of growth and seeks more investments than savings, deficits tend to occur. You may have noticed that during the pandemic, early days of the pandemic, when we went into a lockdown and economic activity was muted, we had a surplus, a trade surplus, because local domestic demand was not high, because of which we didn't need to import as much as we used to. So imports were actually lesser than exports at that point in time in terms of value. Then, as the pandemic eased and restrictions were slowly removed, the domestic economy came back into action, demand rose, and imports also rose. So we slowly see that imports have exceeded exports, and we have a trade deficit. Trade deficit feeds into the current account deficit of a country. That's a CAD. What else constitutes the CAD is a matter for another conversation, but generally the trade deficit is the most significant component of the CAD. And when I say trade, I include both goods and services. Generally, when the trade deficit widens, so does the CAD. For a country like India, so what is a healthy CAD? It's generally measured as a percentage of GDP, for better understanding. Late last year, RBI Deputy Governor Mr. Michael Patra had said in a speech that India can sustain a deficit to GDP ratio of 2.5 to 3%. Private brokerage UBS Securities pitches the sustainable number more conservatively at 1.72%, and it estimates that for this year, FY23, our CAD would touch 3% of GDP. For the quarter ended December 2021, which is the latest official data we have on hand, CAD touched 2.7%, which is a 13-quarter high. But for the whole year ended March 2022, exports really saved the day for us. They grew at a searing pace and exceeded our own target of $400 billion. India Ratings estimates that for the year ended March 2022, our CAD would be about 1.8% of GDP. Even though this is well within the sustainable number that RBI refers to, this itself could be a 3-year high. And if exports did well last year, going ahead, there will be significant challenges because of all the uncertainty in the air. Geopolitical tensions, the Ukraine-Russia war, which is sending oil prices rising, commodity prices have gone up. So a lot of uncertainty, and sure enough, if you see the May 2022 numbers, imports have grown 56%, while exports have only grown 15%. So if this trend continues, there's a significant chance that the CAD could widen further. What does a trade deficit do to the local currency? When imports exceed exports, it means that the demand for a foreign currency goes up and demand for the local currency comes down. Basic economics would tell you that when demand for a certain commodity goes down, the price also declines. Likewise, when traders who want to import goods or services from abroad, they tend to trade in rupees for that particular foreign currency so that they can make those purchases. So there is downward pressure on the rupee depreciates, goes down in value. If the CAD keeps widening, the RBI may not have too much of a choice but to let the rupee weaken further. Some reports had estimates that the rupee would touch 78 to a dollar by March 2023. These assumptions were in place because they thought, on average, oil would be trading at $100 per barrel. But in the recent past, oil has been trading in the 115 to 120 per barrel. So the future looks really cloudy for the rupee. What happens when a currency weakens? Importantly, in a country like ours, it has a telling effect on all of our imports. But because we talked about oil, oil is a good example. We ship in or import 85% of our oil needs from outside. So a year ago, if the rupee was trading at 73 to a dollar and you need $100, you would trade in 7,300 rupees for $100. Today, it's nearer 7,800 rupees. And India as a country imports millions of tons of oil. So you do the math. Oil is just an example. All imports could be impacted by a weakening rupee. Gold is a favorite for the Indians, and more recently, electronics. If your laptop, your smartphones, your washing machines, if a significant part of these gadgets comes from imports, then you'll be shelling out more for the same unit than earlier, which means lesser disposable income for you. Not only for you, but even for the government. If it has to make those purchases, then if it does not want to pass on the pain of those costs to the end consumer, then it takes the hit, and which means it has less to spend on education, health, so on and so forth. So isn't this a good reason for you to keep an eye on the export-import numbers? Write in and tell us in the comments section. We'd love to hear from you. For now, goodbye.